Crude oil prices have surged to nearly a 5-month high amid escalating tensions between Israel and Iran. Brent crude rose above $76 per barrel, while US WTI also climbed past $75, reflecting sharp gains of more than 4% in a single trading session. The surge is directly linked to market fears over a potential disruption in oil supply routes, especially the strategic Strait of Hormuz, a choke point through which nearly 20% of global seaborne oil passes. As geopolitical tension intensifies in the Middle East, investors are bracing for broader supply chain impacts and possible escalation. The Crude Oil Volatility Index, OVX, has spiked significantly, indicating growing concern and uncertainty in the market. Analysts suggest that any damage to Iranian infrastructure or a block in the Strait of Hormuz could push oil prices toward the $90 to $150 range. Interestingly, amid this crisis, investors are pivoting toward energy stocks as a defensive hedge rather than traditional safe havens like gold or government bonds. This shift highlights market expectations of sustained volatility and inflationary pressure if the conflict persists. Meanwhile, although oil prices eased slightly during mid-Asian trade as traders booked profits and waited for clearer signals from the US Federal Reserve, the general sentiment remains tense. The oil market is currently pricing in a geopolitical premium, anticipating possible supply disruptions from the Middle East. Energy importing nations may feel the heat in the coming weeks if tensions continue to rise, leading to ripple effects on inflation, transportation costs, and manufacturing. In summary, the current spike in oil prices reflects a volatile mix of military tension, supply fears, and market anxiety. With the Israel-Iran conflict threatening to impact one of the world's most crucial oil corridors, the coming days are critical for global markets and energy security.